So here's something wild that most people don't realize. You can actually buy real estate without putting down a single dollar of your own money. And I'm not talking about some sketchy scheme or illegal workaround. I'm talking about legitimate strategies that investors had been using for decades. Now, before you click away thinking this is another one of those get-rich-quick videos, let me be clear about something. This isn't easy. It's not passive, and it definitely requires work, knowledge, and strategy. But it's absolutely possible, and by the end of this video, you're going to understand exactly how people do it. Here's what's crazy. I spent months researching this, talking to actual investors, reading through case studies, and you know what I found? The reason most people think you need 20% down is because that's what banks tell you. That's the traditional path. But there are at least 7 different ways to buy property without that massive chunk of cash sitting in your account. And here's what I'm going to do in this video. I'm going to break down every single strategy, show you the real numbers, explain the risks nobody talks about, and by the end, I'm saving the most powerful technique for last. It's the one strategy that literally changed how I think about real estate investing. And honestly, it's the one that makes the most sense for people starting from zero. So if you're sitting there thinking, I want to invest in real estate, but I don't have $50,000 lying around for a down payment, this video is for you. If you're tired of watching your rent money disappear every month while your landlord builds equity, this is for you. And if you've ever wondered how some people seem to acquire multiple properties while you're struggling to save for one, well, you're about to find out. Let's get into it. Section 1. Why everyone thinks you need money down and why they're wrong. Okay, so first things first, let's talk about why this myth exists in the first place. When you go to a traditional bank and say, hey, I want to buy a house, they're going to tell you the same thing every time. You need a down payment. Usually 20% for investment properties, sometimes as low as 3.5% for your primary residence if you're using an FHA loan. And look, that's not wrong. That is one way to do it. But here's the thing most people don't understand. Banks aren't the only game in town. They're just the loudest. Think about it this way. A bank is a business, right? They have a specific business model. They lend money, they charge interest, they require down payments to minimize their risk. That's their system. But real estate transactions don't have to go through banks. In fact, some of the most creative and profitable real estate deals happen completely outside the traditional banking system. I remember when I first learned about this, it kind of blew my mind. I was talking to this investor who owned like 14 rental properties, and I asked him, how much money did you have to save up for all these down payments? And he looked at me and laughed. He said, I haven't used my own money for a down payment in 7 years. Wait, what? Yeah, that was my reaction too. So here's what's actually happening in the real estate world that nobody tells you about. There are seller-financed deals where the person selling the property acts as the bank. There are partnership structures where you bring the skills and someone else brings the capital. There are lease options, subject-to deals, wholesaling strategies, house hacking methods, and creative financing techniques that completely bypass the traditional system. And before you think, okay, but those must be rare or super complicated, let me tell you something. In 2023, roughly 8 to 12% of real estate transactions involved some form of seller financing. That's not a tiny number. That's hundreds of thousands of deals happening every year where buyers didn't need to go to a bank. Now, here's where it gets interesting. Why don't more people know about this? 2 reasons. First, real estate agents and loan officers make money from traditional transactions. They're not incentivized to tell you about creative financing, not because they're bad people, but because that's just not how they're trained or compensated. And second, these strategies require more knowledge and negotiation skills. They're not as simple as filling out a loan application. You actually have to understand what you're doing, and that's what we're here to fix. Here's the reality. Traditional down payments exist to protect the lender. That makes sense from their perspective, but if you can structure a deal where either the seller is protected in a different way or where someone else is providing the capital in exchange for something else you bring to the table, then the whole you must have cash requirement disappears. Let me give you a concrete example. Let's say there's a property worth $200,000. In a traditional scenario, you'd need $40,000 down for an investment property at 20%. That's a massive barrier. But what if the seller owns the property free and clear? And what if they're more interested in monthly income than a lump sum? You could potentially structure a deal where you buy the property with 0 down, and instead you pay them $1,500 a month for the next 15 years at 6% interest. If the numbers work and you can rent it out for $1,800 a month, you've just created $300 monthly cash flow without using any of your own money for the purchase. Is that easy to find? No. Does it require negotiation and finding the right seller? Absolutely. But is it possible? 100%. And that's just one strategy. We're going to cover 7 different approaches, each with their own pros, cons, and ideal situations. But before we get into the specific strategies, we need to talk about something crucial that most YouTube videos skip over. We need to talk about what you're actually bringing to the table when you don't have money. Okay, here's where we need to get real for a second. When you don't have money, you might be thinking, what do I have to offer? And that's actually the exact right question to ask. Because in any transaction, there has to be value exchange. So if you're not bringing capital, what are you bringing? This is the part that separates people who successfully do no money down deals from people who just dream about them. The currencies you can trade instead of cash are your time, your skills, your credit, your knowledge, or equity in the deal itself. Let me break down each one because this is crucial. Your time. This is the most obvious one. If you're willing to find the deals, manage the property, handle the rehab, deal with tenants, do the paperwork, and basically act as the operator, that has value. Huge value, actually. A lot of people with money don't want to deal with the day-to-day. They want passive returns. If you're willing to be active, that's your leverage. Your skills. Can you renovate? Can you find off-market deals? Are you good at marketing? Can you analyze deals quickly? These skills have monetary value. Someone who can take a distressed property and turn it into a cash-flowing asset is worth partnering with, even if they don't have capital. Your credit. If you have a good credit score, let's say 700 or above, that's an asset. You can get approved for loans that other people can't. You can qualify for financing that investors with cash but poor credit can't access. Your credit is literally bankable currency in these deals. Your knowledge. This one's underrated. If you understand markets, can run numbers, know how to find deals, and can spot opportunities others miss, that knowledge is valuable. Information asymmetry is real in real estate. Equity sharing. This is when you give up a percentage of future profits or ownership in exchange for not putting money down now. You're trading future value for present opportunity. Now, here's what most people get wrong. They think, okay, I'll just find someone with money and we'll split it 50-50. But that's not how it works unless you're bringing something equally valuable to the table. Think about it from the money person's perspective. They're putting up $40,000 in capital. That money has opportunity cost. They could invest it in the stock market and get 10% annually with zero work. So why would they give you 50% of a real estate deal just because you found the property? They wouldn't, unless you're bringing something that makes the deal significantly better or completely unavailable without you. This is where strategy comes in. You need to position yourself as essential to the deal, not just as someone who needs money. And there are specific ways to do this that we'll cover in the partnership section. But here's the fundamental principle you need to understand. In no money down deals, you're not getting something for nothing. You're creating value in other ways. The most successful zero-down investors I've studied all have one thing in common. They became really, really good at one specific aspect of real estate that made them valuable to partners or sellers. Some became expert at finding off-market deals. Some became masters at property analysis and could evaluate a deal in 20 minutes that would take others 2 days. Some built relationships with contractors and could renovate for 30% less than market rate. Some became incredible at tenant management and could keep occupancy at 98% while others struggled at 80%. The point is, you need to develop a valuable skill that makes you worth partnering with or makes sellers willing to work with you on creative terms. And here's something I wish someone had told me earlier. Your age and experience can actually be an advantage if you position it right. If you're in your late 20s or early 30s and you're learning this stuff now, you have 30 to 40 years to compound this knowledge. Someone who's 55 and has capital might want to partner with someone younger who's going to actively manage properties for the next 2 decades. That's a value proposition right there. Okay, so now that we understand what we're actually trading, let's get into the specific strategies. And I'm going to go from the most accessible to the most advanced. So stick with me because each one builds on the last. Strategy number 1, house hacking. Live for free while building equity. All right, let's start with the most approachable strategy if you're just getting started: house hacking. This is probably the single best way for a regular person to get into real estate with minimal money down. And the reason it works so well is because you're using a loophole in the lending system, though it's not really a loophole, it's by design. Here's how it works. When you buy a property as your primary residence, you can get an FHA loan with as little as 3.5% down. Some conventional loans go as low as 3% for first-time buyers. Compare that to investment properties, which typically require 20 to 25% down. So the strategy is this: you buy a 2 to 4 unit property, live in one unit, and rent out the others. The rental income covers your mortgage payment, and you're essentially living for free while building equity in an asset. Let me show you the actual numbers on a real deal. Let's say you find a duplex for $300,000 in a decent neighborhood. With an FHA loan, you'd need $10,500 down, 3.5%. Let's add in closing costs of about $7,500. So you're all in for roughly $18,000 out of pocket. Your mortgage payment at current rates, let's say 7% interest over 30 years, would be about $1,863 per month. Add in insurance, property tax, and maintenance reserve, and you're looking at maybe $2,400 total monthly housing cost. But here's where it gets good. If you live in one unit and rent out the other unit for $1,400, your actual housing cost is now $1,000 per month. And if you were going to rent anyway, you were probably paying $1,500 to $1,800 for a comparable place. So you've just reduced your living expenses by $500 to $800 per month while building equity in a property. Over 1 year, that's $6,000 to $9,600 in savings, plus whatever principal paydown happened on your mortgage, probably another $4,000 to $5,000 in year one. But wait, there's more to this. After living there for 1 year, you can move out, rent your unit too, and now both units are covering the entire mortgage. Meanwhile, you can go buy another owner-occupied property with another low down payment loan and do it again. This is how some people acquire 3 or 4 properties in 4 years with minimal capital. You're using the owner-occupied loan benefits repeatedly while building a portfolio. Now, let me address the obvious concerns, because I know what you're thinking. I don't want to be a landlord to someone living next door. Fair. It can be weird. But honestly, it's not that bad if you set clear boundaries and screen tenants properly, and you're only doing it for a year before you can move on. What if the tenant doesn't pay? Valid concern. This is why you need to screen thoroughly. Credit checks, employment verification, previous landlord references, don't skip these steps. And honestly, having them right next door means you'll know pretty quickly if something's off. What if I can't find a duplex in my market? This is actually a real challenge in some cities. Duplexes can be competitive, but here's an alternative. Buy a 3-bedroom house and rent out 2 rooms to roommates. Same concept. Your roommates cover most or all of your mortgage. It's not quite as powerful as a duplex where you have completely separate units, but it works. The beauty of house hacking is that it's the closest thing to zero down that works through traditional lending. Yes, you need $10,000 to $20,000 depending on the property price and loan type, but compared to $60,000 down on a $300,000 investment property, it's a massive difference. And here's a pro tip that almost nobody talks about. You can negotiate with the seller to cover your closing costs. It's called a seller concession. So if you have $10,500 for the down payment, but you're short on the closing costs, you can offer asking price but request $7,500 in seller concessions. In a buyer's market, sellers will often agree because they're more concerned about getting the property sold than saving a few $1,000s on closing costs. I've seen people house hack their way to financial freedom. I know someone who did this 4 times between 2019 and 2023 and now owns 4 properties that collectively cash flow $2,800 per month after all expenses. That's life-changing passive income built from just being willing to live in multi-unit properties for 4 years. But okay, let's say you don't even have $10,000, or you don't want to house hack. Let's talk about the next strategy. Section 4, strategy number 2, seller financing. Become the bank's customer without the bank. This is where things get really interesting.
Seller financing is when the person selling the property agrees to act as the bank. Instead of you getting a mortgage from Wells Fargo or whoever, the seller essentially loans you the money and you make payments directly to them. Now, immediately, you're probably thinking, why would anyone do that? Great question. Let me explain the situations where this makes perfect sense for a seller. First, imagine someone who owns a property free and clear. They're 68 years old, they've paid off their mortgage, and they're looking to sell. If they sell traditionally, they get a lump sum of cash, let's say $250,000. Great, right? Well, maybe not. If they put that $250,000 in the bank, they're getting what, 4 to 5% interest right now? That's $10,000 to $12,500 per year, and they get hit with capital gains tax on the sale immediately. But what if instead they sold you the property with seller financing at 7% interest? You pay them $1,800 per month for 20 years. They make $432,000 over the life of the loan, way more than the $250,000 lump sum. Plus, they spread the tax burden over 20 years instead of taking it all at once. And they have the property as collateral, so if you stop paying, they foreclose and get the property back plus all the payments you already made. From their perspective, this can be a better deal than a traditional sale. Second scenario, the seller is struggling to sell. Maybe the property needs work and banks won't lend on it in its current condition. Maybe it's in a declining market. Maybe it's been sitting for 6 months with no offers. A seller-financed offer might be their best option to get the property off their hands. Third scenario, the seller wants passive income. Maybe they're retiring and they want steady monthly checks rather than a lump sum they have to manage and invest. Seller financing creates predictable income. So, how do you actually structure this? Here's a basic framework. You find a property that's owned free and clear or has a small mortgage remaining. You approach the seller, usually through their real estate agent if they have one, and propose a seller-financed deal. A typical structure might look like this. Purchase price, $200,000, down payment, 0, or maybe $5,000, $10,000 if they insist on something, interest rate, 6 to 8%, usually higher than traditional loans, term, 20 to 30 years, or a balloon payment after 5 to 7 years, monthly payment based on an amortization schedule. Wait, let me explain that balloon payment thing because it's crucial. A balloon payment is when you structure the loan with regular monthly payments for a set period, say 5 years, but at the end of those 5 years, the remaining balance is due in full. So you might pay $1,400 per month for 60 months and then owe $180,000 as a lump sum. Why would you agree to that? Because in 5 years, you can refinance with a traditional bank. By then, you've built equity, the property has, hopefully, appreciated, and you can get a conventional loan to pay off the seller. Or you sell the property and pay them off that way. From the seller's perspective, the balloon payment gives them an exit if they change their mind about long-term income, and it reduces their risk of being tied to you for decades.
Now here's the part where this gets real, finding these deals. Seller financing isn't common. Maybe 8 to 12% of transactions involve it. And a lot of those are partial seller financing, not 100% financing. So you need to be proactive. You're looking for properties that are 1. Owned free and clear. You can find this through public records. Owned by older individuals who might want income. Listed for a while without selling. In need of repairs that prevent traditional financing. In declining or stagnant markets where sellers are motivated. Your offer needs to benefit them. Don't just say, "Will you finance this for me?" Position it as, "I'd like to offer you a solution that gives you monthly income, tax advantages, and security with the property as collateral." If you can rent the property for more than your payment to them, you have positive cash flow with 0 money down. Real example. I know an investor who bought a $175,000 property with seller financing in 2021. 0 down, 7% interest, $1,280 monthly payment. He rents it for $1,650. That's $370 monthly cash flow on a property he bought with no money. After 3 years, he refinanced it with a bank at a lower rate, paid off the seller, and now his cash flow is $520 per month. That's the power of seller financing when you structure it right. But here's the downside. It's hard to find. You might make 20 offers before one seller agrees. You need to be persistent and build relationships. And you need to know what you're doing. Get a real estate attorney to review any seller-financed contract. Okay, so that's seller financing. Let me show you another approach that's similar, but with a twist. Section 5, strategy number 3, lease options. Control property without owning it. All right, this one's clever, really clever. A lease option is when you lease a property with the option to buy it at a predetermined price within a specific time frame. You're essentially renting with the right but not the obligation to purchase later. Here's why this works for no money down investing. You control the property and can profit from it without actually buying it up front. Let me break down how this works in practice. You find a property owner, let's say they have a house worth $220,000 that they're struggling to sell, or maybe they're facing foreclosure. You approach them with this deal. I'll lease your property for $1,500 per month for 3 years, and I want the option to buy it for $225,000 anytime during those 3 years. In exchange, I'll handle all maintenance and keep the property occupied. Why would they agree? Because they get guaranteed income, someone responsible taking care of their property, and a potential sale in the future at a price that works for them. Now here's where you make money. You immediately find a tenant buyer. This is someone who wants to buy a house but can't qualify for a mortgage right now. Maybe their credit is damaged, maybe they're self-employed and can't prove income, maybe they just went through bankruptcy, but they have income and they're working on their situation. You offer them a lease option too. You can rent this house for $1,850 per month for 3 years, and you have the option to buy it for $245,000 anytime in that period. So let's do the math. You pay the owner $1,500 per month. Your tenant buyer pays you $1,850 per month. Your monthly profit is $350. But wait, there's more. Typically in these deals, you collect an option fee up front from the tenant buyer, maybe $5,000 to $10,000. That's non-refundable money they pay for the right to purchase the property later. That's profit number 2. And if they do exercise their option and buy the property, you buy it from the owner for $225,000 and sell it to them for $245,000. That's a $20,000 spread. So your total profit could be monthly cash flow, $350 times 36 equals $12,600, upfront option fee, $7,500, sales spread, $20,000. Total profit, $40,100. And you never actually bought the property, you controlled it through the option. Now obviously this is a best case scenario. Here are the risks. What if the tenant buyer never buys? You've made the monthly spread and the option fee, which is still good, but you don't get the purchase spread. And at the end of your lease with the owner, you either need to buy it yourself, extend your lease, or walk away. What if property values drop? If that $220,000 house is only worth $200,000 in 3 years, your tenant buyer isn't going to pay $245,000 for it. The deal falls apart. What if the owner sells to someone else? This is why you need a properly recorded option agreement. You need legal protection that prevents them from selling out from under you. But when it works, it's phenomenal. You're essentially acting as a middleman, matching someone who wants to sell or can't afford their property with someone who wants to buy but can't get financing yet. The key is finding motivated sellers and qualified tenant buyers. You're looking for motivated sellers, inherited properties they don't want to manage, landlords tired of dealing with tenants, people facing foreclosure, properties that won't sell traditionally, qualified tenant buyers, steady income but poor credit, self-employed individuals, people with bankruptcy in their recent past, families who need time to improve their financial situation. I saw a case study from 2022 where someone did 4 lease option deals simultaneously, combined monthly cash flow of $1,400, upfront fees totaling $28,000, and 2 of the properties sold with spreads totaling $35,000. Total profit over 3 years, $88,400, with zero money invested in purchasing any properties.
The challenge is that this is very hands-on. You're dealing with 2 parties, the owner and the tenant buyer, and if either one has issues, you're in the middle. You need good contracts, good communication, and honestly, you need to be selective about who you work with. But as a no money down strategy, it's legit. Okay, we're about a third of the way through this, and if you're still watching, I want to acknowledge something. This isn't easy information to absorb. We're covering complex strategies that most people never learn. The fact that you're sticking with this tells me you're serious about making this work. So let's keep going. because the next few strategies get even more interesting. And hey, if you're getting value from this, do me a favor and hit that like button. It helps the algorithm show this to more people who need it. All right, let's keep moving. Section 6, strategy number 4, subject to deals, the most misunderstood strategy. Okay, buckle up, because this one confuses a lot of people at first, but once you get it, it's incredibly powerful. A subject to deal means you buy a property subject to the existing mortgage. In other words, the seller deeds you the property, but their mortgage stays in place and stays in their name. You just start making the payments. Wait, what? Can you even do that? Yes. It's legal, but it's complicated, and there are risks for both parties, which is why you don't hear about it much. Here's the scenario where this makes sense. Imagine a homeowner who's underwater on their mortgage or facing foreclosure. They owe $180,000 on a house that's worth $200,000. They can't sell it traditionally because after realtor fees and closing costs, they'd walk away with nothing or even owe money, and they can't afford the payments anymore. You approach them and say, "I'll take over your payments. You deed me the property and I'll make sure the mortgage gets paid every month. This saves your credit from foreclosure and you walk away without owing anything." They agree. You now own the property, but the mortgage is still in their name. You're making payments on their loan. From your perspective, you just acquired a property with zero down payment. If the mortgage payment is $1,400 a month and you can rent it for $1,800, you're cash flowing $400 per month, minus your expenses for maintenance, property tax, and insurance, etc. But here's the big catch. Most mortgages have a due on sale clause. This means if the property changes hands, technically the lender can call the entire loan due immediately. In practice, this rarely happens. As long as the payments keep coming in on time, most lenders don't even notice or care. They're getting their money. But it is risk. If the lender does call the loan, you'd need to either refinance it in your own name or sell the property. Second risk, you're relying on the fact that the seller doesn't mess with things. The mortgage is in their name, so if they decided to file bankruptcy or do something that affects the loan, you could have problems. This is why you need title insurance and proper legal agreements. Third risk, the seller's credit is still tied to this loan. If you stop paying, it destroys their credit. So ethically, you'd better make damn sure you can afford those payments before you take over someone's mortgage. But when done right, subject to deals can be incredible. Real example from 2023, an investor found a seller who was 3 months behind on payments and facing foreclosure. The property was worth $235,000 and they owed $198,000. The investor took over the property subject to, caught up the back payments, $6,800, and now makes $380 in cash flow after all expenses. Total out of pocket, $6,800. That's not zero, but it's way less than a $47,000 down payment on a traditional purchase. The key to subject to deals is finding sellers in distress. You're looking for pre-foreclosures, divorces where neither party wants the house, job relocations where someone needs to move quickly, inherited properties with mortgages the heirs can't afford. And you need to be upfront about the risks. Don't hide the due on sale clause. Explain it clearly. Have them talk to an attorney. This has to be win-win, not you taking advantage of someone in a desperate situation. Some investors do dozens of subject to deals. Some never do any because they're uncomfortable with the risks. It's a personal decision based on your risk tolerance. But from a no money down perspective, it's one of the few ways to acquire property with truly minimal capital, sometimes just enough to cover a few months of back payments or some light repairs. One more thing on subject to deals. You can combine this with other strategies. For example, you could acquire a property subject to and then immediately do a lease option with a tenant buyer. Now you're controlling two properties, the one you acquired and the one they'll eventually buy, with very little money. The creativity in real estate is endless once you understand these mechanisms. All right, let's shift gears and talk about partnerships, because this is how a lot of people get started when they truly have zero capital. So you've probably heard about partnerships. Someone has money, someone has time or expertise, they split the dual. Simple, right? Not exactly. Here's what most people get wrong about partnership deals. They assume it's automatically 50-50.
And sometimes it is, but usually the person with the money has more leverage than the person with time, especially if that person's time isn't bringing unique value. Let me explain the real economics of partnership deals.
If I have $50,000 to invest and I partner with you, I'm taking on financial risk. My money is locked up in this asset. I could put that money in an index fund and get 10% returns with no effort. So for me to give you 50% of the deal, you need to be bringing something that makes this opportunity significantly better than my alternative investments. What could that be? Finding off-market deals. If you have a system for finding properties below market value that aren't listed on the MLS, that's valuable. Anyone can find listed properties. Not everyone can find off-market deals at a discount. Managing the property. If you're going to handle all tenant issues, maintenance calls, rent collection, and property management, that has value. Property managers typically charge 8 to 10% of rental income. If you're doing this work, that's part of your contribution. Renovating below market cost. If you can personally do renovations or you have contractor connections that save 20 to 30% on rehab costs, that's real value. A property that needs $40,000 in renovations that you can do for $28,000 just created $12,000 in value. Expertise in analysis. If you can quickly evaluate deals, understand market trends, know which neighborhoods are appreciating, and make smart acquisition decisions, that expertise is worth something. Here's a more realistic partnership structure for someone without capital. Scenario A, the finding fee. You find the deal, negotiate it, and bring it to a money partner. They put up 100% of the cash. You split the equity 20-80 in their favor, but you get 50% of cash flow after their initial investment is returned. Or you get a flat fee of $5,000 to $10,000 for finding the deal and they own it outright. Scenario B is the sweat equity. They provide the down payment and closing costs. You manage the property for free for the first 2 years. After 2 years, you split equity 30-70 or 40-60 depending on the property's performance. You get your share of equity without ever putting in capital. Scenario C is the skills play. They put up the money, you do the renovation work personally. You split any profit from the flip 50-50, or if it's a rental, you split equity and cash flow equally because your labor created the value. The key principle, you need to bring value equal to what they're bringing. Let me give you a real framework for this. Let's say you find a property that's worth $250,000 after repairs, but you can buy it for $180,000 and it needs $30,000 in work. Total investment needed, $210,000. If you can find that deal and negotiate it, that's worth something. If you can manage the renovation, that's worth something. If you can handle leasing it and managing tenants, that's worth something. A fair split might be, they put up $210,000, 100% of capital. You find the deal, manage renovation, handle leasing, sweat equity. You split ownership 60-40 in their favor. You split cash flow 50-50 after expenses. And if you sell, you split profit after they get their initial investment back plus 8% annually. This is fair because they're making returns on their capital and you're being compensated for your work with equity and ongoing cash flow. Now here's how you actually find money partners. First, you need to know your numbers inside and out. No money partner is going to give you capital if you can't explain the deal clearly, show them comps, run an accurate analysis, and demonstrate you understand what you're doing. Second, you need to start networking. Go to local real estate investor meetups, join bigger pockets and participate in forums. Connect with people in your area who invest. Don't immediately ask for money, that's weird. Just build relationships and learn. Third, when you find a solid deal, present it professionally. Create a simple deal package that includes property details and photos, purchase price and estimated value after repairs, renovation budget with line items, comparable sales in the area, projected rental income with market rent comps, cash flow projections for 5 years, your role and their role clearly defined, proposed equity and cash flow split, and exit strategy options. Make it look professional. Use a tool like Canva or PowerPoint. Show them you've done your homework. Fourth, understand that you'll probably get rejected a lot. That's okay. You're learning to pitch deals, and each rejection teaches you something. Maybe your numbers were off, maybe you didn't find the right partner, maybe the deal wasn't as good as you thought. Keep refining. Here's something I learned from talking to successful partnerships. The best money partners aren't your friends or family. I know that sounds counterintuitive, but mixing money and personal relationships can get messy. The best partners are people who invest in real estate already,
understand the risks, and view this as a business transaction. And one more crucial thing, get everything in writing. Use an attorney to create an LLC or partnership agreement. Define exactly what happens if someone wants out, if the property doesn't perform as expected, if one partner wants to sell and the other doesn't. Cover all the scenarios before they happen. I know someone who started with zero capital in 2020, partnered on their first deal with a 70-30 split in the money partner's favor, proved they could execute, and by deal 3, they were getting 50-50 splits because they'd built trust and proven their value. Now they own equity in 6 properties without ever using their own capital for down payments.
That's the power of partnerships when you approach them strategically. But let's talk about another strategy that doesn't get enough attention. Section 8, Strategy 6. Wholesaling, cash flow without ownership. Okay, so wholesaling is interesting because you're technically not even buying property. You're acting as a middleman who finds deals and assigns them to end buyers. Here's how it works in the simplest terms. You get a property under contract at a below-market price, then you sell that contract to an investor for a fee before the closing happens. You never actually own the property, you're just facilitating the transaction. Let me walk you through an actual example. You find a distressed property, maybe through driving for dollars, literally driving around looking for rundown houses, direct mail campaigns, or online searches. The owner is motivated to sell. The property is worth $200,000 in good condition, but needs $40,000 in work. You negotiate a price of $130,000 with the seller. You sign a purchase contract with them, but here's the key. Your contract includes an and or assigns clause. This means you can assign your rights to purchase to someone else. Now you find an investor, a house flipper or landlord who wants the property. You say, I have this property under contract for $130,000. It's worth $200,000 fixed up. I'll assign you my contract for a $10,000 assignment fee. They agree because it's still a good deal for them. They're getting a property they can buy for $140,000, $130,000 plus your $10,000 fee that will be worth $200,000 after $40,000 in repairs. That's $20,000 profit potential for them. You make $10,000 without ever buying the property or using any of your own money. That's wholesaling in a nutshell. Now, before you think this is easy money, let me tell you where this gets challenging. First, finding motivated sellers is hard work. You need to market consistently. Direct mail to distressed properties, cold calling, door knocking, online marketing. It's all very sales heavy and requires persistence. Most wholesalers make 100+ offers before getting one accepted. Second, you need a buyer's list. You can't just find a property and hope you can find someone to buy it. You need relationships with investors who have cash and are ready to move quickly. Before you even start wholesaling, you should be networking with flippers and landlords in your area. Third, you need to know values cold. If you think a property is worth $200,000, but it's actually only worth $180,000, your numbers don't work and the deal falls apart. You need to be able to estimate repair costs accurately and know comparable sales in every neighborhood you work in. Fourth, timing is critical. Most wholesale deals have 30 to 45-day closing periods. You need to find a buyer and get them under contract before your closing date with the seller. If you can't, either you close on it yourself, which requires money you might not have, or back out of the deal, which damages your reputation. But here's why people do this. It's pure cash flow. That $10,000 is yours. No mortgage, no property management, no tenants calling at 2 a.m. You facilitated a transaction and got paid for it. Some wholesalers do one deal per month and make $60,000 to $120,000 per year. That's a solid income. Others do multiple deals per week and make serious money. Real example, in 2022, I came across a wholesaler in Phoenix who did 47 deals that year with an average assignment fee of $8,500. That's $399,500 in income from wholesaling. No properties owned, just hustle, marketing, and deal flow. But let's be honest about the downsides. Wholesaling has gotten a bad reputation in some circles because some people do it unethically. They tie up properties under contract with no intention or ability to close if they can't find a buyer, which wastes sellers' time. They lowball desperate homeowners and take advantage of people in distress. They promise things they can't deliver.
If you're going to wholesale, do it ethically. Only work with truly motivated sellers who understand what you're doing. Be transparent that you're a wholesaler looking to assign the contract. Don't tie up properties unless you have a real buyer's list ready to move. Make sure your numbers are conservative and accurate. Have an earnest money deposit you're willing to lose if you can't perform. And also, know that some states have regulations around wholesaling. In some places, you need a real estate license to wholesale. In others, there are specific disclosures required. Check your local laws. And here's a hybrid strategy. Instead of wholesaling, you could use an option contract. Instead of getting the property under purchase contract, you pay the seller $500 to $1,000 for a 30-day option to buy. If you find a buyer, you exercise your option and assign it. If you don't, you're only out the option fee. This reduces your risk and is cleaner legally in many states. The bottom line on wholesaling, it's not passive, it's not easy, but it's one of the only ways to generate real estate income with almost zero money. Your investment is time, marketing costs, and hustle. All right, we've covered 6 strategies so far. Let's recap real quick before we get to the last one, which honestly might be the most powerful if you have good credit. We've talked about house hacking, living in one unit while renting others, seller financing, the seller acts as your lender, lease options, controlling property through options, subject to, taking over existing mortgages, partnerships, trading your skills for equity, wholesaling, making fees without ownership.
Each one works in different situations. Each one requires different skills. And honestly, the best real estate investors use a combination of these strategies, depending on what deals come their way. But there's one more strategy we need to cover, and this one's huge. Section 9, strategy number 7, the BRRRR method with cash-out refinance, the infinite return strategy. Okay, this is the one I promised you earlier. This is the strategy that when I first learned about it, completely changed how I think about real estate investing. It's called BRRR, stands for Buy, Rehab, Rent, Refinance, Repeat. And the magic of this strategy is that you can eventually get all your money back out and own a cash-flowing property with none of your capital stuck in it. That's what investors call infinite return. You're making returns on money you no longer have invested. Let me walk you through this step by step because it's a bit more complex than the others. Step 1. Buy. You find a distressed property that needs work. Banks won't lend on it in its current condition, so it's often cheaper. You buy it with cash, and I know we're talking about no money down, so stay with me, we'll address this. Let's say you buy a property for $100,000 cash that needs significant rehab. Step 2. Rehab. You renovate the property. You put in $30,000 of work. New kitchen, new bathrooms, flooring, paint, whatever it needs. Total investment $130,000. Step 3. Rent. You find a tenant and get it rented out. Now it's producing income. Let's say $1,400 per month. Step 4. Refinance. Here's where the magic happens. After the property is renovated and rented, you go to a bank and get it appraised. The property now appraises for $180,000 because you added value through renovations. The bank will typically lend you 75% of the appraised value on an investment property. 75% of $180,000 is $135,000. You take that $135,000 loan and you pay back your initial $130,000 investment. You just got all your money back plus an extra $5,000. Now you own a property that's worth $180,000, has a mortgage of $135,000, cash flows $200 to $300 per month after the mortgage payment, and you have your $130,000 back to do another deal. Step 5. Repeat. You take that $130,000 and do it again, and again, and again. This is how some investors go from one property to 10 properties in just a few years without continuously needing more capital. They're recycling the same money over and over. But okay, you're thinking, that's great, but you said no money down. This requires $130,000 to start.
Right, here's where you combine strategies. You can partner with a money partner for the first deal. They put up the $130,000, you find the deal, manage the renovation, handle the leasing. When you refinance, you split the equity that remains. Let's say after the refinance, there's $45,000 in equity, $180,000 value minus a $135,000 loan. You split that equity 50-50 or whatever you negotiate. They get their $130,000 back plus $22,500 in equity for your work. Then you do it again with a new partner or the same one. Or you could use a private money lender. This is someone who lends money for real estate deals at higher interest rates, typically 8 to 12%, for short terms, usually 6 to 12 months. You pay them back when you refinance plus interest. Or you could use a hard money lender. These are companies that specialize in lending for fix and flip and BRRRR deals. They'll lend based on the after repair value of the property, not the purchase price. So they might lend you 90% of the purchase price plus 100% of the rehab costs, and you only need to come up with 10 to 20% down instead of paying cash. Let me show you real numbers with a hard money lender. Purchase price, $100,000. Hard money lender gives you $90,000, 90% of purchase. Your cash needed for purchase, $10,000. Rehab costs, $30,000. Hard money lender gives you $30,000, 100% of rehab. Your total out of pocket, $10,000. After repairs, the property is worth $180,000. You refinance for $135,000, 75% of value. You pay back hard money lender $120,000 plus interest, maybe $128,000 total. You get back $7,000. Okay, so in this scenario, you're not getting all your money back because you're paying interest and fees to the hard money lender. But you started with just $10,000, and now you own a property worth $180,000 with $45,000 in equity and positive cash flow. The numbers work differently on every deal, but the principle is the same. You're using leverage and refinancing to recycle capital and build a portfolio faster than traditional buy and hold investing. Now, let me address the risks, because BRRRR is not without challenges. Risk 1. The property doesn't appraise high enough. If you think it'll appraise for $180,000, but it only comes in at $160,000, you won't be able to refinance all your money. You might get $120,000, 75% of $160,000, and you're still stuck with $10,000 in the deal. This is why accurate ARV estimates are crucial. Risk 2. Renovation costs overrun. If you budget $30,000 but it ends up costing $45,000, your numbers are blown. Always build in a 10 to 20% contingency for unexpected issues. Risk 3. The property doesn't rent for what you projected. If you thought you'd get $1,400 but you can only get $1,200, your cash flow is reduced. Do thorough market rent research before buying. Risk 4. Interest rates change. If rates go up between when you buy and when you refinance, your mortgage payment will be higher than projected, reducing cash flow. Risk 5. Market timing. If property values drop between purchase and refinance, the whole strategy can fall apart. But despite these risks, BRRRR is incredibly powerful for building wealth when done correctly.
I know an investor who did 8 BRRRR deals between 2019 and 2024. Started with $150,000 from a partner, recycled that money through 8 properties, now owns 8 rentals worth a combined $1.4 million, with about $650,000 in total mortgages. That's $750,000 in equity and roughly $2,400 per month in combined cash flow. And the original $150,000 was returned to the partner after the second deal. That's the power of this strategy. The key is finding the right properties, ones that are undervalued and can be improved enough to force appreciation. You're not waiting for the market to go up. You're creating value through intelligent renovations. And here's a bonus tip. Focus on functional improvements, not cosmetic ones for the best return. A new roof, updated electrical, or added square footage through a bedroom conversion will add more value than granite countertops. Though nice finishes help too, the structural and functional stuff matters most for appraisals.
All right, so those are your 7 strategies. Now let's talk about something that most YouTube videos never cover, the real risks and how things can go wrong. Section 10. What can go wrong? The risks nobody talks about. Look, I've been pretty optimistic so far about these strategies because I want you to understand what's possible. But let's get real for a minute. Real estate investing with no money down is riskier than traditional investing, and you need to know what you're getting into. First major risk, you're typically using more leverage. When you put 20% down on a property, you have equity cushion. If the market drops 10%, you're still fine. But if you buy with 0 down and the market drops 10%, you're underwater immediately. You owe more than the property is worth. This happened to millions of people in 2008, 2009. People who bought with no money down or low money down got destroyed when values crashed. They couldn't sell without bringing cash to closing, and they couldn't refinance because they had no equity. So rule number 1, don't use no money down strategies in overheated markets where prices have been climbing irrationally. You need a margin of safety. Second major risk is that cash flow can be tighter. When you buy with 0 down, you typically have higher debt payments. Whether it's a higher interest rate on seller financing or a bigger mortgage from refinancing at 75% LTV instead of 80% LTV, your payments are usually higher than traditional deals. This means if your tenant moves out for 2 months, or if you have a major repair, you might not have the cash reserves to cover it. You could be forced to sell at a bad time or go into foreclosure. So rule number 2, you need emergency reserves. Even though you didn't use money for the down payment, you need cash reserves for vacancies, repairs, and emergencies. I'd recommend at least 6 months of expenses saved per property. Third major risk is that you're dealing with more complicated structures. Seller financing, subject to deals, lease options, these aren't standard transactions. If something goes wrong, you can't just call your mortgage company and work it out. You're dealing with individual sellers, partners, or tenant buyers who might not understand or fulfill their obligations. I've heard horror stories. A subject to seller filed bankruptcy and it triggered the due on sale clause. A lease option seller decided to sell to someone else and claimed the option agreement wasn't valid. A partnership dissolved because partners disagreed on whether to sell or hold. So rule number 3, get everything in writing with proper legal documentation. Pay for a real estate attorney. Don't try to save money by using online templates for these complex deals. Fourth major risk is some strategies require skills you might not have. Wholesaling requires sales skills and deal flow. BRRRR requires renovation management and accurate valuation skills. Partnerships require people skills and negotiation ability. If you don't have these skills, you'll struggle or lose money while learning. So rule number 4, start with the strategy that matches your current skills and be willing to invest time and money in education. Take courses, find mentors, read books. Brandon Turner's The Book on Rental Property Investing is solid. David Green's BRRRR book is excellent for that strategy. Join bigger pockets and learn from people ahead of you. Fifth major risk is the legal and tax implications can be complex. When you're doing creative financing, there are tax consequences you might not expect. Seller financing might be treated differently than a traditional mortgage. Partnerships create K-1 tax forms and can complicate your returns. Subject to deals might have gift tax implications if structured wrong. So work with a CPA who understands real estate investing. Don't try to figure out the tax stuff yourself. The cost of professional advice is way cheaper than the cost of screwing up your taxes. Let me tell you about a real situation I heard about. Someone did a lease option deal, collected option fees from a tenant buyer, and didn't report it as income because they thought it was a deposit. The IRS audited them 3 years later and hit them with penalties and back taxes. Cost them about $8,000 in money they didn't budget for. That could have been avoided with proper tax advice up front. Sixth major risk is that the market timing matters more than people admit. If you buy properties in 2024 with creative financing strategies and the market crashes in 2025, you're in trouble. Even if you did everything right, external market forces can hurt you. Look at what happened during COVID. Some landlords couldn't evict non-paying tenants for months due to eviction moratoriums. If you had tight cash flow because you used no money down strategies, those months of zero income could wipe you out. So rule number 6, don't go all in immediately. Start with one property, learn the business, build reserves, then scale up once you've proven you can handle the challenges.
Okay, here's the thing though. I don't want to scare you away from this. Yes, there are risks. Yes, things can go wrong. But you know what? Things can also go incredibly right. The people who succeed with these strategies are the ones who do thorough due diligence on every deal, build relationships with professionals, attorneys, CPAs, contractors, keep cash reserves even when using no money down strategies, continue learning and adapting, and start small and scale intelligently. Real estate is one of the few wealth-building vehicles where you can use other people's money, other people's time, tenants paying rent, and tax advantages to build serious wealth over time. But it's not a lottery ticket. It's a business. Treat it like one. Section 11. The psychology of starting with nothing. Mindset shifts you need. All right, let's talk about something that might be even more important than the strategies themselves, your mindset. Because here's the truth. The reason most people don't pursue no money down real estate isn't because they don't have money, it's because they don't believe they can do it. They think, who am I to negotiate with sellers? I don't know what I'm doing. Or, why would anyone partner with me? I have no experience. Or, what if I fail and lose everything? Those thoughts are normal, but they're also what keeps you stuck. So let me reframe some things for you. Reframe 1. You're not starting from zero, you're starting with resourcefulness. Even if you have no money, you have something. Maybe it's time, maybe it's energy, maybe it's willingness to learn, maybe it's a strong work ethic. Those things have value in the real estate world. The investor with $500,000 who doesn't have time to find deals, manage properties, or learn new strategies, they need someone like you. The seller who's struggling to sell a property, they need someone who can solve their problem, even if that person doesn't have cash. You're not coming from a position of weakness, you're coming from a position of hunger and willingness to work. Reframe 2. Experience is overrated. Education is what matters. Nobody is born knowing how to invest in real estate. Every single successful investor started knowing nothing. The only difference between them and you is that they spent time learning and then they took action. You can learn 90% of what you need from books, podcasts, YouTube, and online forums in about 3 to 6 months of dedicated study. The last 10% you'll learn by doing. Don't wait until you feel ready. You'll never feel completely ready. Learn enough to be dangerous, then start small. Reframe 3. Failure is feedback, not finality. What's the worst that can happen if you make an offer on a property with creative financing and the seller says no? Nothing. You move on to the next one. What if you pitch a partnership and the money partner declines? Cool. You find another one. The only true failure is not trying because you're afraid of rejection. I heard about an investor who made 47 offers before getting one accepted, 47 no's before one yes. But that one yes led to a property that cash flowed $420 per month, which led to credibility with partners, which led to 3 more deals in the next year. The 47 no's weren't failures, they were necessary steps to the yes. Reframe 4. You don't need to be perfect, you need to be consistent. Real estate investing isn't about being the smartest person in the room. It's about being the most consistent. The person who analyzes deals every week will eventually find a good one. The person who networks every month will eventually meet the right partner. Success in real estate is more about persistence than intelligence. Reframe 5. Start before you're ready, but not before you're educated. There's a balance here. Don't jump into a $200,000 deal without understanding what you're doing. That's reckless. But also, don't spend 5 years learning and never pull the trigger. That's fear masquerading as caution. Learn the fundamentals, analyze 50 to 100 deals to understand the numbers, then make an offer on something. Even if it doesn't work out, you're building skills. Here's what I want you to understand.
The people who succeed with no money down strategies aren't smarter than you. They're not luckier than you. They just decided to start despite not having money, and they figured it out along the way. You can do this. It won't be easy, it won't be fast, but it's absolutely possible if you commit to learning and take consistent action. And look, if you've watched this far, you're already different. Most people clicked away in the first 5 minutes. You've been here for an hour absorbing complex information. That tells me you're serious. So let me tell you what to do next. Section 12, your action plan. What to do starting tomorrow. Okay, so you've learned 7 different strategies, you understand the risks, you've got the right mindset. Now what? Let me give you a concrete 90-day action plan to start moving towards your first no money down deal. Days 1 through 30, education and market research. Your goal this month is to become competent, not expert. Here's what you do. Week 1, read the book on rental property investing by Brandon Turner, listen to at least 10 BiggerPockets podcast episodes, create accounts on Zillow, Realtor.com, and BiggerPockets, and start analyzing listed properties in your market, even though you're not buying yet. Week 2, learn how to calculate cash flow, cap rate, and cash-on-cash return. Use the BiggerPockets calculators to analyze 20 properties. Join your local REIA, Real Estate Investors Association, and attend 1 meeting. Start a spreadsheet tracking properties you analyze with notes on why they would or wouldn't work. Week 3, research property values in 3 to 5 neighborhoods in your area. Find out what properties are renting for on Zillow, Apps.com, and Craigslist. Drive through target neighborhoods and look at property conditions. Identify 2 to 3 areas where you want to focus your investing.
Week 4. Decide which strategy fits your situation best. House hacking if you can live in a multi-unit, wholesaling if you're good at sales, partnerships if you have a professional network, etc. Find a real estate agent who works with investors. Interview 3 to 4 agents. Ask about their experience with investment properties. Find a real estate attorney in your area. Call 2 to 3. Ask about their experience with creative financing. Set up Google alerts for terms like motivated seller, foreclosure, and your target neighborhoods. By the end of month 1, you should be able to look at a property and quickly assess whether it could work as a rental investment. Days 31 to 60, building your team and finding deals. This month is about relationships and deal flow. Week 5, attend another REIA meeting and actually talk to people. Ask experienced investors if you can buy them coffee and pick their brain. Join Facebook groups for real estate investors in your city. Start following local real estate investors on social media. Week 6, if you're going the partnership route, make a list of everyone you know who might have investment capital or might know someone who does. If you're going the wholesaling route, start building your buyers list by connecting with flippers and landlords. If you're doing creative financing, start looking for properties that have been listed for 60-plus days. Connect with at least 5 potential team members, contractors, property managers, etc. Week 7, make your first offer on a property, even if you're not 100% sure, just to practice. Analyze 30 more properties to sharpen your skills. If pursuing seller financing or lease options, send letters to expired listings offering creative solutions. Start building your criteria checklist. What makes a good deal for your chosen strategy? Week 8. Attend 1 more investor meetup, make 2 to 3 more offers on properties, have coffee or a call with at least 1 potential partner or mentor, and refine your deal analysis based on feedback from offers that were rejected. By the end of month 2, you should have made at least a few offers, met several local investors, and have a clearer picture of what deals look like in your market. Days 61 to 90, taking action and getting your first deal. This is when things get real. Week 9. Increase your deal flow. Look at 50 properties this week. If house hacking, get pre-approved for an FHA or conventional loan. If partnering, present your first formal partnership proposal to someone. If wholesaling, send marketing to at least 100 potential sellers. Week 10. Make 5 to 10 offers this week. Yes, that many. You need volume. Follow up on previous offers that didn't work out. Situations change.
Deepen relationships with 2 to 3 key people in your network. Study successful deals in your market. What did they pay? What did they sell or rent for? Week 11. Continue making offers. If you get a deal under contract, celebrate, but also immediately start due diligence. Get a property inspection if you're actually buying. If you're wholesaling, immediately contact your buyers list. Week 12. Close on your first deal. Or don't beat yourself up if you haven't yet. 90 days isn't a magic number. Some people close in 60 days. Others take 6 months. The point is that you're now actively in the game, not just learning about it. Assess what's working and what's not, and adjust your strategy. Daily habits to maintain throughout. Spend 30 minutes analyzing deals. Spend 30 minutes on education, reading, podcasts, YouTube. Reach out to at least one person in your network. Track your numbers. How many properties analyzed? How many offers made? How many conversations had? Here's the thing about this action plan. It's not complicated, but it requires consistency. Most people quit after week 3 because they're not seeing results yet. Don't be that person. Real estate investing is a marathon, not a sprint. But if you follow this plan, you'll be further ahead in 90 days than 95% of people who say they want to invest in real estate. And remember, your first deal will be the hardest. It will take the longest. You'll make mistakes. That's okay. The second deal will be easier. The third will be easier still. By your 5th deal, you'll wonder why you were so nervous about the first one. Now, if you're enjoying this and finding it valuable, do me a favor, hit that subscribe button and turn on notifications. I put out content like this regularly, and honestly, it helps me keep making these long-form, in-depth videos when I see that people are engaging. All right, let's keep going because we need to talk about the numbers more specifically. Section 13, the math behind cash flow, understanding the real numbers. So we've talked about strategies, but let's get into the actual math because this is where a lot of people get tripped up.
Let me walk you through a complete analysis using a real example. Let's say you find a small single-family home. Purchase price, $180,000. It needs about $15,000 in light cosmetic work. Your plan is to use a partnership where your partner puts up the money, you manage everything, and you split equity and cash flow. Here's how the numbers break down. Acquisition costs. Purchase price, $180,000. Closing costs, 3%, $5,400. Renovation, $15,000. Total investment, $200,400. Financing. You refinance after renovations at 75% LTV based on a new appraised value of $220,000. Loan amount, $165,000. Mortgage at 7% over 30 years, $1,097 per month. Monthly income, rent, $1,750 based on comps in the area. Monthly expenses, mortgage, $1,097. Property tax, $2,400 per year, $200. Insurance, $1,200 per year, $100. Maintenance reserve, 10% of rent, $175. Vacancy reserve, 8% of rent, $140. Property management, if not self-managing, $0. You're doing it. Total monthly expenses, $1,712. Monthly cash flow, $38. Wait, what? Only $38 per month? That doesn't seem worth it, right? Hold on. Let's look at the full picture. Total return analysis. Number 1, cash flow, $38 per month. AMIV equals $456 per year. 2, principal paydown. In year 1, roughly $2,100 of your mortgage payments go toward principal. That's equity you're building. 3, appreciation. If the property appreciates at just 3% per year, that's $6,600 in year 1. $220,000 times 0.03. 4, tax benefits. Depreciation allows you to write off $8,000 per year, approximately. $220,000 house value divided by 27.5-year depreciation schedule. If you're in a 25% tax bracket, that saves you $2,000 in taxes. Total year 1 return. Cash flow,
$456, principal paydown, $2,100, appreciation, $6,600, tax savings, $2,000. Total, $11,156. Now, remember, after the refinance, your partner got their $200,400 back, and there's $55,000 in equity, $220,000 value minus $165,000 loan. If you split that equity 50-50, you have $27,500 in equity immediately. So your share of returns year one is roughly $5,578, half of $11,156. And you have $27,500 in equity, all without using any of your own money. You just manage the process. That's why cash flow alone doesn't tell the full story. You need to look at total returns. But here's what's important. Those numbers I just showed you, they're optimistic. Let me show you what happens when things go wrong. Stress test scenario. What if the tenant moves out after 8 months and it takes you 2 months to find a new one? Lost rent, $3,500. Turnover costs, cleaning, minor repairs, marketing, $800. Your cash flow just went from positive $456 to negative $3,844 for the year. What if you have a major repair? Water heater dies, roof leak, foundation issue? Unexpected repair, $4,000. Now you're at negative $7,844. This is why I keep hammering on cash reserves. Even with no money down strategies, you need money set aside for the inevitable problems. Here's my rule. For every property you acquire, you should have $5,000 to $10,000 in reserves minimum. I don't care if you didn't use money for the down payment. You need reserves. Now, let me show you the flip side, a really good deal with the same strategy. Better deal example. Purchase price, $140,000. Renovation, $20,000. Total investment, $167,000, including closing. After repair value, $210,000. Refinance at 75% LTV, $157,500. You almost get all your money back. Rent, $1,850. Mortgage at 7%, $1,047 per month. Total monthly expenses, $1,687. Monthly cash flow, $163. This is better. That's $1,956 per year in cash flow, plus all the other benefits we mentioned. And the deal was structured better because you bought at a bigger discount to ARV. The lesson here is the quality of your deal determines everything. A mediocre property with tight margins will stress you out. A good property with built-in equity and solid cash flow will make your life easier. So, how do you find the good deals? You look at a lot of properties, you make a lot of offers. You get good at quickly identifying which properties have potential and which don't. Here's a quick framework I use. The 1% rule, rough filter. Monthly rent should be at least 1% of the total investment. So if you're all in for $180,000, rent should be at least $1,800. This isn't perfect, but it's a quick filter. If a property doesn't come close to 1%, it's probably not worth deeper analysis in most markets. The 50% rule, expense estimation. Operating expenses, everything except mortgage, will typically eat up about 50% of your rental income. So your cash flow is rent minus expenses minus mortgage. Quick math to see if a deal works. The 70% rule for BRRRS and flips. Never pay more than 70% of the after-repair value minus repair costs. So if ARV is $200,000 and repairs are $30,000, you shouldn't pay more than $110,000. $200K times 0.70 minus $30K. This ensures you have enough margin for profit and unexpected issues. These aren't exact rules. They're filters to quickly assess deals. If a property passes these rough filters, then you do deeper analysis. And here's something crucial. Your market matters tremendously. In some markets, like parts of the Midwest, you can find properties where the 1% rule works easily. $100,000 properties renting for $1,200 to $1,400. Cash flow is great. In other markets, like coastal California or New York, the 1% rule is impossible. A $500,000 property might rent for $2,500. You're investing for appreciation and tax benefits, not cash flow. Know your market. Don't try to force strategies that don't fit your area's economics. Okay, so that's the math behind individual deals, but let's talk about the bigger picture, building wealth over time. Section 14, the long game, building real wealth through real estate.
Let me show you a realistic scenario. Let's say you start with house hacking in year 1. You buy a duplex, live in one side, rent the other. You're building equity and living cheaply. Year 2, you move out, rent both sides, and buy another house hack. Now you own 2 properties. Year 3, you use one of the creative strategies we discussed, maybe a seller-financed deal or a partnership, and acquire a 3rd property. Year 4, you do a BRRRR deal with a private moneylender and acquire property number 4. So after 4 years, you own 4 rental properties. Let's say combined value $880,000. Combined mortgages, $630,000. Equity, $250,000. Monthly cash flow after all expenses, $1,200 combined. That's a solid foundation. But here's where it gets interesting. What happens over the next 20 years? The 4 ways real estate builds wealth. 1. Cash flow. Your tenants pay you more than your expenses, and that gap grows over time as rents increase, but your mortgage payment stays fixed. 2. Appreciation. Properties increase in value over time. Even at a conservative 3% per year, that compounds significantly. 3. Loan paydown. Every month, your tenants pay down your mortgage principal. You're building equity while they're building your wealth. 4. Tax benefits. Depreciation, mortgage interest deductions, and other tax advantages save you thousands per year. Let's run the numbers forward 20 years on those 4 properties. Year 20 projection. Assuming 3% appreciation and normal amortization, combined property values $1,590,000, appreciating from $880,000. Combined mortgages $420,000, paid down from $630,000. Equity $1,170,000. Monthly cash flow $3,800 as rents increased and mortgages stayed fixed. So you went from $250,000 in equity and $1,200 monthly cash flow to $1,170,000 in equity and $3,800 monthly cash flow. That's $920,000 in wealth creation, plus $45,600 per year in passive income. And remember, you built this starting with minimal capital by using the strategies we discussed. But wait, there's more. In year 20, you're in your 40s or 50s. You have options. Option A, keep them all as rentals. Live off the $45,600 per year cash flow while continuing to build equity. Option B, sell 1 or 2 properties. Maybe you sell 2 properties, pay off the mortgages on the other 2, and now you own 2 properties free and clear, generating even more cash flow. Option C, use the equity. Do a cash-out refinance on 1 property to invest in more properties, starting the cycle again. Or option D, live in 1. Move into your nicest property and live mortgage-free while collecting rent from the others. This is financial freedom. This is what real estate investing builds toward. But here's what most people don't talk about. The middle years are tough. Years 5 through 12 are often called the grind. You own properties, but you're still working your job. You're dealing with tenant calls, you're managing maintenance, your cash flow is okay but not life-changing. You're building equity, but it's not liquid. A lot of people quit during the grind. They sell their properties and take the equity gains, which is fine, but they give up the long-term compounding. The investors who make it to financial freedom are the ones who push through the grind. They understand that wealth building is a marathon. Here's another way to think about it.
Every rental property is like an employee who shows up to work for 30 years, never complains, never asks for a raise, and slowly pays you more and more over time. Would you fire that employee after 5 years because they're not making you rich fast enough? No, you'd appreciate the consistent value they're providing. And here's something most people don't realize. The first property is the hardest. Everything gets easier after that. Once you have one successful rental, banks see you as a real estate investor. Partners see you as someone who can execute. You have proof of concept. Acquiring properties 2 through 5 is significantly easier than acquiring property number 1. I know investors who took 3 years to get their first property, then got 5 more properties in the next 3 years. The momentum builds. Now, let me address something important: scaling intelligently. Some people get their first property and immediately want to buy 10 more. That's usually a mistake. You need to learn the business first. My recommendation: get one property, manage it yourself for a year, learn what tenants are like, deal with repairs, understand the reality of being a landlord. Then get a second property, then maybe a third. Once you have 3 to 5 properties and you understand the systems, you can start scaling faster if you want, but don't try to get to 20 properties in year 2. That's how people lose money and burn out. Quality over quantity, especially in the beginning. And here's a perspective shift. You don't need 50 properties to be financially free. If you own 5 to 10 properties free and clear in your 50s or 60s, generating $5,000 to $8,000 per month in cash flow, you're probably more financially secure than 90% of Americans. Real estate doesn't have to make you a billionaire to change your life. It just needs to generate enough passive income to give you freedom, options, and security. That's the long game. That's what you're building toward with these no-money-down strategies. Now, for Section 15, the tax advantages nobody explains properly. Okay, we need to talk about taxes because this is one of the most powerful aspects of real estate investing that gets glossed over in most videos. I'm not a CPA, so you need to work with a tax professional for your specific situation, but let me explain the general principles that make real estate so tax advantageous. Depreciation, your biggest tax advantage. The IRS says that residential real estate loses value over 27.5 years. Now, we all know that's not true. Properties usually appreciate, but for tax purposes, you get to pretend your property is declining in value. Here's how it works. If you buy a property for $200,000, the IRS says $160,000 is the building, which depreciates, and $40,000 is the land, which doesn't depreciate. You get to deduct $5,818 per year in depreciation, $160,000 divided by 27.5 years.
So even if your property is cash flowing $3,000 per year, you can show a tax loss of $2,818, $3,000 income minus $5,818 depreciation. You made money, but you don't pay taxes on it. In fact, you might even offset other income. This is completely legal and encouraged by the tax code. Mortgage interest deduction. All the interest you pay on your mortgage is tax deductible. In the early years of a mortgage, most of your payment is interest. So if you pay $12,000 per year in mortgage payments and $10,000 of that is interest, you deduct $10,000 from your taxable income. Operating expense deductions. Every expense related to your rental property is deductible. Property management fees, repairs, maintenance, insurance, property taxes, travel to the property, education related to real estate, even your accountant's fees, all deductible. No payroll taxes. Rental income isn't subject to FICA taxes, Social Security, and Medicare taxes. If you earn $50,000 at your job, you pay 7.65% in payroll taxes. If you earn $50,000 from rental income, you don't pay those taxes. That's a $3,825 difference. 310-1 exchange, deferring capital gains indefinitely. When you sell a rental property, you typically owe capital gains tax on your profit, but if you use a 310-1 exchange, you can roll that profit into another property and defer the taxes indefinitely. You can keep doing this throughout your life, constantly upgrading to better properties without ever paying capital gains tax. And when you die, your heirs inherit the property at a stepped-up basis, meaning the tax liability disappears entirely. This is how wealthy families build and transfer wealth across generations. Cost segregation, advanced strategy. This is where it gets really interesting for people doing BRRRR or buying properties with significant value. Cost segregation is when you hire a specialist to break down your property into different components with different depreciation schedules. Instead of depreciating the entire property over 27.5 years, you might depreciate the carpet over 5 years, appliances over 5 years, landscaping over 15 years, etc. This accelerates your depreciation deductions in the early years. I know an investor who bought a $400,000 property and used cost segregation to create an $80,000 paper loss in year one. He offset $80,000 of his W-2 income and saved about $25,000 in taxes. That's real money back in his pocket. Real estate professional status. If you or your spouse qualifies as a real estate professional, spending 750 plus hours per year in real estate activities, and it's your primary income source, you can use your rental losses to offset all your ordinary income, not just passive income. This is how high-income earners, doctors, lawyers, tech workers, can dramatically reduce their tax bills through real estate. They buy properties, show losses on paper through depreciation, and offset their high W-2 income. Again, this requires working with a knowledgeable CPA, but it's completely legal. The bottom line on taxes. Real estate is probably the most tax-advantageous investment available to regular people. The government incentivizes real estate investment because it provides housing, which is a social good. When you combine cash flow that's often tax-free due to depreciation, wealth building through appreciation and loan paydown, the ability to defer capital gains through 310-1 exchanges, and deductions for all expenses, you have an incredibly powerful wealth-building vehicle. This is why wealthy people love real estate. It's not just about the returns, it's about the tax efficiency of those returns. Okay, we're getting close to the end here, and I promised you something big. I told you at the beginning that I was saving the most important strategy for last, so let me deliver on that promise. Section 16, the strategy that changes everything. The final piece. All right, here it is. The strategy that I think is the most powerful for building wealth with minimal capital, especially if you're starting from zero. It's not one of the 7 strategies we discussed. It's a combination of them executed in a specific order that creates a wealth-building machine. I call it the stacking strategy. Here's how it works. Phase 1, house hack to build capital, years 1 to 2. You start with house hacking because it's the most accessible entry point. Buy a duplex or multi-unit with an FHA loan, 3.5% down. Let's say you save $12,000 for the down payment and closing costs on a $240,000 duplex. You live in one unit, rent the other. Your housing costs go to near zero or even negative. Over 2 years, you're saving $10,000 to $15,000 per month compared to renting. That's $24,000 to $36,000 in savings. Plus, you're building equity through appreciation and loan paydown, maybe another $10,000 to $20,000. Phase 2, partner on a BRRRR deal, year 2 to 3. Now you have proof of concept. You're a landlord. You understand the business. You take the $25,000 to $35,000 you've accumulated and find a money partner. I'll put in $30,000. You put in $120,000. We'll do a BRRRR deal together. I'll manage the entire process. We'll split equity 60-40 in your favor, but split cash flow 50-50.
You do the deal. After the refinance, your partner gets their $120,000 back, you get your $30,000 back, and you both own equity in a cash-flowing property. Phase 3, recycle your capital, year 3 to 4.
You just got your $30,000 back from the refinance. Now you use it for another BRRRR deal, but this time you're the primary investor. Maybe you bring in a smaller partner for the remaining capital, or you use a hard money lender. Do another BRRRR deal, get your money back out, repeat. Phase 4. Add creative deals. Years 4 to 6. Now you're established. You have 3 properties. You have experience. You have credibility. Now you start layering in seller financing deals, subject to deals, and lease options when you find them. These don't require much capital, so you're expanding your portfolio without needing more money. Phase 5. Scale with systems. Years 6 to 10. By year 6, you own maybe 8 to 12 properties. Your combined cash flow is $3,000 to $5,000 per month. Your equity is $500,000 plus. Now you hire a property manager to run everything. You systemize your deal-finding process. You're not working harder, you're working smarter. You're reviewing deals, approving big decisions, but you're not dealing with tenant calls at 10 p.m. Phase 10 plus, financial freedom. By year 10 to 15, you own enough property that the cash flow replaces your job income. You can retire from your W-2 if you want, or keep working but with zero financial stress. Your properties have appreciated. Your mortgages are getting paid down. You have over $1 million in equity. You're generating $6,000 to $10,000 per month in passive income. You're financially free. This is the stacking strategy. You start with the most accessible method, prove yourself, then use progressively more sophisticated strategies as you gain experience and credibility. The beauty of this approach is that each phase builds on the previous one. You're not trying to do everything at once. You're building a foundation, then expanding. And here's why this works better than just doing one strategy repeatedly. You're diversifying your approach. Some years, seller financing opportunities are plentiful. Other years, BRRRR deals make more sense. Some markets favor house hacking, others lease options. By understanding multiple strategies and using them strategically, you're always able to find deals regardless of market conditions. This is exactly how several successful investors I've studied built their portfolios. They didn't stick to one playbook. They adapted based on what was available. And look, I know what you're thinking. This sounds great in theory, but will it actually work for me? I don't know. I can't promise you success. What I can tell you is that thousands of people have done this. They started with nothing or very little, they learned the strategies, they took action consistently, and they built wealth through real estate. Are you going to be one of them? That depends on whether you're willing to do the work. Because here's the final truth. Real estate investing with no money down is 100% possible, but 0% passive at the start. You're trading time and effort for capital. Over time, as you build wealth and systems, it becomes more passive, but in the beginning, you're grinding. You're analyzing deals at night after work. You're attending investor meetups on weekends. You're learning about mortgages and appraisals and lease agreements. You're making offers that get rejected. You're having uncomfortable conversations with sellers and partners. It's work. But it's work that builds an asset. It's work that compounds over time. It's work that can set you and your family up for generational wealth. So the question isn't, can I do this? The question is, am I willing to do this? If the answer is yes, you have everything you need. The strategies are in this video. The action plan is laid out. The knowledge is available. Now it's just about execution. Conclusion. Your next steps. The final call to action. All right, we've covered a ton in this video. Let me summarize the key points before we wrap up. The 7 strategies for no money down real estate are house hacking, living in one unit, renting the others; seller financing, the seller acts as your bank; lease options, controlling property through options; subject to deals, taking over existing mortgages; partnerships, trading skills for equity; wholesaling, making fees on deals you find; BRRRR deals, buy, rehab, rent, refinance, repeat. Each strategy has its place. Each works in different situations. The most successful investors use multiple strategies depending on what opportunities they find. The critical principles to remember. You're not getting something for nothing. You're trading time, skills, knowledge, or future equity for the ability to acquire property without capital up front. Cash reserves are non-negotiable. Even though you're not using money for down payments, you need money for emergencies, repairs, and vacancies. Quality deals matter more than creative financing. A good property with traditional financing beats a mediocre property with creative financing every time.
Start small and scale intelligently. Don't try to buy 10 properties in year 1. Master the basics first. Education and action both matter. Learn enough to be competent, then start making offers and learning through experience.
Real estate is a long-term game. Expect it to take 10, 20 years to build serious wealth. Anyone promising faster results is probably selling something. Your immediate next steps. If you're serious about this, here's what you do right now, today. 1. Pick one strategy to focus on for the next 90 days based on your situation. Don't try to do all 7. 2. Educate yourself for 30 days. Read 1 book, listen to 20 podcast episodes, analyze 50 properties. 3. Build relationships for the next 30 days. Attend investor meetups, connect with agents and lenders, join online forums. 4. Take action for the final 30 days. Make your first offers. Have partnership conversations. Send marketing to sellers. 5. Track your progress. Write down how many properties you analyze, how many offers you make, how many people you meet. Measure what matters. And look, I know this is overwhelming. We just spent 2 hours going deep on complex strategies. Your head is probably spinning. That's normal. This is a lot of information. Don't try to absorb everything at once. Watch this video again. Take notes. Focus on the one strategy that makes sense for your situation and learn everything about that strategy specifically. Join communities where you can ask questions. Bigger Pockets is great. Local REIA groups are valuable. Find a mentor if you can. And remember, everyone who's successful in real estate started where you are right now. Overwhelmed, uncertain, probably a little scared. But they pushed through and took action anyway. You can do this. Real estate investing with no money down isn't a fantasy. It's not reserved for special people with connections or advantages you don't have. It's available to anyone willing to learn the strategies, put in the work, and stay consistent over time. The question is, are you going to be one of the people who actually does this, or one of the people who just watches videos and dreams about it? I hope you choose to take action. Before I let you go, if this video provided value, and I mean real actionable value, hit that like button and subscribe to the channel. It helps me enormously, and it helps YouTube show this content to more people who need it. Drop a comment and let me know which strategy you're most interested in pursuing. I read every comment and I'll respond to as many as I can. And if you want to go even deeper, I've got more content on this channel breaking down specific strategies, walking through real deal analysis, and interviewing investors who've actually done this. Thanks for spending these 2 hours with me. I hope it changes your financial trajectory. Now, go take action. Analyze a property today. Make an offer this week. Attend an investor meetup this month. Your future financially free self will thank you. Let's build some wealth.